I wouldn't underestimate the power of scale in this market. Number one is if you have scale, it means you're seeing a lot of opportunities and it means you can be selective in the things that you're doing. That's good for investors. I think from a lender perspective, meaning for the borrower's standpoint, having scale oftentimes means that you may have a multifaceted platform where you aren't just able to provide a single solution like direct lending, but you actually have the ability to be a broader solutions provider. So if you and I are engaging in a conversation around a solution for your portfolio company, we might be able to bring a solution that is relevant to you as opposed to just being able to provide senior lending or junior lending based on the capability of our fund. Yeah, look, it's been a very healthy capital markets environment. And so if you look at the middle market today, we're seeing very active participation from both private credit as well as the banks. And so what that means from a pricing perspective is we've generally seen pricing in true mid-market deals range anywhere between SOFR plus 450 all the way up to SOFR 500 for what I would call a healthy performing, to use a golf terminology, an up the fairway type transaction. I think as you look at profiles that maybe where the deal has a little bit more complexity, that's really where you start to see terms widen from there. And so it's very much a get what you pay for type environment. I'd say when you look at the spectrum, both above and below the middle market, the higher up the market you go, the fewer number of companies, the more competitive it is between banks and non-banks. And so obviously we see tighter pricing and more borrower-friendly terms at the upper end of the market. As you go down the market, you tend to find an environment where it's a more inefficient market. And so as a result of that, as well as the small business risk that you're taking, lenders typically get better price and better structure, but there's a trade-off. It's an important question and topic for our industry. I think from our vantage point, there is a lot of runway for private credit. So if you look at just the statistics within private credit, as of this last year, there was basically a $1 trillion funding gap between the amount of equity buyout dry powder that's been raised and not spent and the amount of credit capital that's been raised and not spent. And we don't think that gap is going to be filled necessarily by the banks in its entirety. So there's a lot of runway for private credit just with that data point alone. I think when you look at the other part of the market, which is a growing maturity wall, over the next few years, there's comfortably over $500 billion in deals that are maturing that will need fresh capital. And so if you bring those two stats together, we comfortably estimate at least for the next few years, there's about $1.5 trillion of opportunity for private credit. And we think that that's pretty exciting for the asset class. We're very optimistic in terms of our outlook for credit for a few reasons. I'd say number one is, when you look at the fundamentals, the macro backdrop is on a very stable footing. I think secondly, when you look at the return potential, investors are poised to generate at least 200 basis points of more yields in this asset class in the decade following 2022's rising rate environment relative to the decade leading up to 2022's rising rate environment. Despite the fact that we're in a declining rate environment, there still is that yield premium. I think when you look historically at the performance of the asset class, facts are facts. This is an asset class that has generated, nearly a quarter century of positive performance in every single vintage year, and has generated positive benchmark outperformance in every single vintage year. And so from our vantage point, there's nothing that would suggest that that won't continue as we look forward.